Now it's time to introduce our first speaker. He is representing the Labour Fund team. He is a good friend. He has also a very interesting sense of humor. He's a Harvard graduate. Dr. Jarmo Kotilaine is the Chief Planning and Monitoring Officer of Tamkeen. Having joined the organization in 2016, he has served as the Chief Economist in the Bahrain Economic Development Board since 2012. He previously worked as Chief Economist at the National NCD Bank of Saudi Arabia. Please welcome Dr. Jarmo Kotilaine.
Very good morning to you, ladies and gentlemen, friends, colleagues. You will have noticed on the head slide about the target audience for this event, it didn't list economics. Very sensibly, because economics, of course, is a profession that is all about supposedly reasonable, rational thinking. Economists think of themselves as rational thinkers. The only problem is by the time the economics profession figures out how the economy operates, the economy has already changed. One economist actually, to his credit, won the Nobel Prize for this some decades ago. Thank you very much for giving me this chance to share my economist's take on what is happening to unreasonable thinking in the GCC region. You'll be hopefully relieved to hear that I am an unreasonable, unconventional, highly skeptical economist, always happening. I think what the region is looking at is a major economic paradigm shift, and a paradigm shift that, while it comes with some challenges, will ultimately deliver fantastic things, new opportunities, an era of innovation and creativity like we've never seen before. So in that sense, I think what is happening as we speak is that the age of innovation is coming to the Gulf, and long may it last. Let me start with a bit of a historical background here. The GCC economies were built on oil. This was, if you like, the first major transformation of the modern era that turned literally everything on its head in this part of the world. It established what I call the oil government nexus as the backbone of the economic model of the GCC countries. The oil assets belonged to the government extracted the oil, and then it distributed the revenues from this oil into various other activities. So on the left there you have a picture of the oil government nexus in the Bahraini context. What was the challenge of this model, and what remains the challenge of this model from the economic perspective is that being essentially a redistributive model, it is also a very static model. What it has delivered over the decades is a steady rise in public sector employment, universal subsidies, which have been good in some ways, but have also represented very static, distorted input pricing with all the complications that anybody who has gone through Economics 101 would be familiar with. It has delivered generous welfare provision, and of course, it has resulted in a growing array of state-owned enterprises, not because people like state-owned enterprises as such, but because the state has been the primary source of capital. Now, of course, some countries in the region have for years accepted the fact that oil can be a fickle friend and oil assets are ultimately finite, and therefore they should start thinking about diversification. And of course, Bahrain, more than any other country in this part of the world, has been at the forefront of this progressive thinking. And here's a quick summary of how the Bahraini economy has diversified itself with great success over the decades, really starting in the 1930s when our silver sponsor decided that it made sense to capture more of the oil value chain than just crude oil extraction and exportation. But even in Bahrain, the diversification story to date has been primarily a government-led diversification story. And in many cases, it has been a diversification story that has benefited from and been sustained by these universal subsidies that I was talking about. Nonetheless, it has delivered impressive progress. So here's the composition, the evolution of the composition of Bahrain's real GDP since the year 2000. And the black bit there, not surprisingly, is the oil and gas sector. And you can see how the relative proportion of oil and gas has come down dramatically from more than 43% of Bahrain's GDP to less than 20%. It was just over 18% in the year 2017. And bear in mind, throughout this period, the oil and gas sector has actually grown in absolute terms. It's just the other sectors have grown faster than the oil and gas sector. So today, we can with some pride say Bahrain is a truly diversified economy in terms of its GDP composition. But the past still remains with us, and the old economic model hasn't completely gone away. When we look at the different aspects of economic diversification in Bahrain beyond the GDP composition, we actually see quite an uneven picture. We have a fantastic story in terms of GDP composition. We have a mixed picture when we look at other, what I call, axes of diversification. Labor market, we've made good progress. 2/3 of the Bahraini national labor force today works in the private sector, but there's still a lot of work to be done in terms of encouraging participation, developing skills, etc., which is, of course, why Tamkeen exists to facilitate this process. When we look at the composition of exports, we've made reasonable progress, but you can see it is primarily in the area of services, not huge advances in the area of non-oil exports. And the non-oil exports today still are very heavily dominated by aluminium and aluminium products. What this means in practice is that not a lot of Bahraini companies export to other markets. So this is a limitation of the diversification story. The biggest limitation, of course, as anybody who looks at the government final accounts or budgets knows, is the fiscal system is still 100% a legacy operation of the old oil government nexus. In other words, you look at that orange line there, and 80+% of government revenue still comes from oil and gas. So this is the exact opposite of the GDP composition. We have a GDP composition where 80+% of value added comes from the non-oil sector. You can see this is a significant mismatch, and in the current oil price environment, we can all see what the consequences of this imbalance are. So, a good story, but a mixed story. And what I think has been happening in the region for some time, and this realization has really been accelerated or deepened by the oil price, unusual oil price cycle since late 2014, is there is a growing recognition that we can't continue with business as usual. That in many areas we are actually facing unsustainable trends, economically speaking. And this slide is not a particularly elegant-looking attempt to summarize some of these unsustainable trends, but you can see, first of all, the demographic situation is very dynamic. The population is going up, a lot of young people. How do we make sure that they all find jobs? Especially when we look at, on the right there, the top right, the labor market dynamics. You can see the black line. This is employment for GCC nationals. This is not a particularly dynamic line. It's a flat line. And what has varied in response to the economic cycle really is employment to foreign workers. So this has been the flexible element. Given the demographic realities, this model will not deliver what is needed, and we all know that. Number two, the old oil government nexus. How can this keep the system going faced with the new oil market realities? And when we look at the oil price graph there since the year 2000, you can sort of see we've been all over the place in terms of oil prices. The average break-even oil price, fiscal break-even oil price, in other words, the price you need to balance your budgets in the GCC with the current fiscal model, varies, of course, country to country, but it is in the neighborhood of $80 a barrel. You can see by looking at this graph that a lot of the time the prices have been well below $80 a barrel. So banking on this is no longer a safe bet. I think perhaps the most fundamental challenge is the last graph there, the bottom right-hand graph, total factor productivity. What is total factor productivity? Well, basically, total factor productivity measures our ability to extract more value out of the inputs that we have. And it is only productivity that, at the end of the day, can deliver sustained increases in living standards. The productivity track record of the GCC countries is dismal, negative numbers for everybody. Why? Because these countries have all grown on what I call an extensive growth model. So you put in more people, you put in more capital, you get more outputs. But you cannot keep putting in more people and more capital, because eventually you will run out of people or capital or land or whatever the case may be. So what do we do in response to these unsustainable trends? Of course, one of the things that the GCC countries have done, very much to their credit, is they've started thinking about how to create more productive, more innovative economies. There have been all kinds of investments and initiatives to bring about this transformation, and this is just a smattering of some of those projects that have been undertaken and continue to be undertaken in the region. Is this enough? To me, the fundamental question here is, what does sustainable innovation look like? Is the purpose of sustainable innovation to win the Nobel Prize, or is it to make money? I think the latter, ultimately, for it to be economically sustainable. And herein lies the challenge of a lot of these initiatives. So if the GCC companies are not buying innovation, then what impact will these initiatives have? I'm not saying they haven't had any impact, they definitely have, but we have not yet, as of today, fully connected the dots. Because at the end of the day, what drives innovation in a market economy? It is not the number of universities you build, although that is related to it. It is market pressure. And this is why I have that quote there from a very confused-looking Mr. Bezos, who knows what he's talking about. In other words, we get sustained innovation when we deny people the alternatives. Companies are forced to innovate when they are faced with uncertainty, when they are faced with a squeeze in their margins. They have to deal with nasty, greedy trade unions, or they have to deal with aggressive competitors, or a government that is putting on new regulations and putting on new taxation, etc. And companies cannot afford not to innovate. And this is the point at which they start investing in innovation and creating capacity for innovation. And herein, ladies and gentlemen, I think lies the great opportunity for the GCC countries today. We've all read the Bahraini vision, the Saudi vision. We know the economic structure of these countries is changing. There is a major fiscal overhaul underway. VAT is coming. The subsidies are going. The old business model is changing, and the backbone, the oil government nexus, is gradually giving way to something else. And what this means is that the business environment facing GCC-based companies is changing profoundly, fundamentally, irreversibly. The old model, where basically You found your line of business where international prices gave you a margin thanks to these subsidized input prices. You got your CR, you put a sign on the door, and you started collecting cash. This is going away, and I am not joking here. Anybody looking at, for instance, the track record of GCC-based petrochemicals producers over the past several decades can see profits were a direct function of the subsidies. In this new environment, the squeeze is on. The margins are becoming tighter. There is a lot more uncertainty. How do you respond? You have to start thinking differently. And there is a growing need now suddenly to achieve productivity gains and start thinking about things like governance, organization, management, cost savings, innovation, etc. So what we are doing is we are moving from an inherently static model to an inherently dynamic model. And this, economically speaking, is fantastic news, because at the end of the day, you cannot have dynamic economies without having dynamic companies. And whatever doesn't kill you makes you stronger. Some of these things that the government is now pressurizing companies with actually come with indirect benefits. One example being taxation. So yes, taxes erode your margins, but they also generate economic data that can inform policymaking. And anybody who has worked with data in this part of the world knows that we could definitely use more of it. We could definitely use better data. Very importantly, once companies have to get their accounts together in a structured manner and start paying tax, we have a capital market. We have a consistent, transparent basis for company valuations. And then we can start thinking about things like mergers and acquisitions, which, guess what, have not happened really at all up to now. And of course, they will make productivity a growth driver at the company level, at the economic level. When we look at, for instance, the data on Bahraini companies, and what I've done here is I've compared the Bahraini data to the international averages or benchmarks, you can see there's a lot of room for improvement. We have lots of companies, but in terms of employment, we're a little behind the global average. And bear in mind, a lot of that employment is cost minimizing foreign low-cost labor, and we are quite far behind in terms of the GDP contribution. Now, the good news is that since companies have operated in this fairly static environment for a long time, there are lots of quick wins, lots of low-hanging fruit. So there are things that companies can do in order to make themselves better companies. They can think about ICT innovations. They can start thinking about exporting to Saudi Arabia and to other regional markets, thereby overcoming the limitations of their small domestic market. Mergers and acquisitions, energy efficiency, renewables, the list goes on. There are many things that companies can do. So companies, it's not the case that companies face no options or no alternatives in this new, more challenging environment. And my personal view is this is what will ultimately make this part of the world, the Arabian Peninsula, one of the most dynamic parts of the global economy. And one of the big advantages it has here is its fantastic location at the crossroads of 3 continents. There's a lot of work we need to do, but I think what is happening now is the critical success factors are coming together. All we need to do, not that this is a trivial task, is connect the dots, keep paying attention, keep tweaking where necessary, and make sure that the emerging ecosystem remains on track and continues to deliver the benefits that we all hope and feel it will deliver. And when we look at the Vision 2030, whether it's Saudi or here, we look at the emerging ecosystem, Startup Bahrain, the FinTech Bay, all kinds of other exciting incentives, I think we have a lot of reason to be optimistic. I thank you for your time and wish you success with this event. Thank you.
Thank you very much, Dr. Jarmo. That was very educational. So now actually we'll move on to, I know that Sohail has already done this, appreciated our sponsors, but we're going to do it formally. So I'd like to invite Sohail back on stage to start the process. Thank you. Give him a big hand, please.